What's the difference between a money market account and a money market fund?
Oh, that's good timing. So, money market account is generally considered money market at a bank, right? Pays less, but has FDIC insurance, and so that's good. Up to 250,000, and I'm not familiar with all the rules of how that works, so you have to make sure you understand that. But a money market fund is actually you go out to a place like Schwab or Fidelity or Franklin or Vanguard, or et cetera, and they have a money market fund, no FDIC insurance, but similar concept in the sense that it's still a $1 share price that doesn't change. I will say in 2008, we saw some money markets, and it was a big deal at the time. It was big news. Some money markets dropped to like 96 cents a share instead of a dollar. And these were mostly high yield money markets, so you do have to be a little bit careful there. But what they're doing is they're buying very short-term, investment instruments, and passing along a fair majority of that yield to you. And that's why when we looked up the Schwab pieces today, it was like 2.7 to 3% on their different money markets, depending on which type you wanted, how much money you had, and that kind of things for the minimum investment. But which is a pretty decent return in today's market. Whereas that money market account at the bank, you might find that that's closer to 1%.
Yeah, and some of those online banks you can get up to 2.5%, so they're not bad either.
Yeah.
But one thing to be concerned about with money market fund ones is you have to actually renew or redeem those shares. You have to sell that share. With a money market account, you could just go and say, I need $5,000 and get it instantly, essentially.
Yeah, that's right.
So there's a little bit of step through that. And the funds also have like different like security backing. So you could get like a treasury backed one versus, something that's like just a general prime market one.
Right.
And so they'll have varying rates depending on what kind of security are in generating those returns.
Yeah, generally the higher security, the lower the fee. So in that range of like, you might get 2.7%. And if you went with a generic one, you might get closer to 3, right? 2.8, that type of thing.
Yeah,
So.
There's always a little bit more risk you take on, a little bit more return you'll get paid.
Right. But I think it's a pretty interesting area to look at in this environment. Again, the interest rates are going up pretty much. We showed you the chart for the 2-year and the 10-year chart earlier. They're going up, pretty much every day. The 3-month Treasury bill is going up. And so the money market has that ability to move kind of even day by day upward instead of locking into a CD or something along those lines. So I think it's a valid thing to look at. Just got to be aware of the risks.